Okay, good evening, everyone. So today we're going to have a brief review of what we discussed so far. We haven't finished this, at least up to the portfolio part, where we assign, where we compute for the portfolio returns, and also the some metrics like the Sharpe ratio, the Jensen's alpha, CAPM, bullish and bearish. Okay, and then after this, we're going to make use of another file, which I'm going to share with you. And we're going to go to a more formal portfolio creation and optimization, and then we're going to create the efficient frontier. However, what we're going to do first is create the efficient frontier via Excel first on Wednesday, and then move on to R. Okay, so on Wednesday we'll have R first, and then Excel to understand what really is happening with the efficient frontier, and then we move to R again to do the efficient frontier. So we have a comparison. All right, so let's load our packages: tidyverse, quant mode, performance analytics. Okay, let's load this. And by now you should be quite familiar already with Apple. Okay, so this is what we used last time. I'm not even sure if, because I have another section that we're using this also. So let's see if maybe I'm using the file of the other section. So towards the end, I think we already have answers, but let's see. So we're creating this object. We know that the get symbols function of quant mode will give us a default download of prices, opening, high, low, close, and then the volume, and then the adjusted, and then it will start with 2007 January, I think January 2, which is the first trading day, and then up to the most current stock prices. So if I run this, okay, we will have now Apple here. Okay, I think let me delete everything first so that we're on the same page. All right, then I'll download Apple. Okay, and we have Apple here. And you will see that the date starts with the default for this year is 2007. Last year, when we downloaded prices, the default was 2006. So it keeps on moving. Okay, let's see this. All right. So that's January 3. And then it gives us the stock prices as of yesterday, March 3. Okay. Okay, I think you don't have any questions about this. This is just a very quick review, and we have to load the data in order to complete this file. Then we just use another date. Start date is January 1, 2015, and the ending date is the end of 2022. And then we use the get symbols, but this time we identified that the symbols is the tick. What's flexible about this is we can define the ticks to be a vector of different stock prices. Okay, so that we can define it. Later on, we'll do that. And then from start up to end, periodicity, can do daily, weekly, monthly. Okay, and assign that auto.assign is equal to false, okay, which means that we are using this name for Apple and not the usual capital AAPL. So let's run this, and we will now have this object, Apple, this XTS object here, XTS object, extensible time series, and it begins with January 2 and ends with December 30, the last trading day of 2022. All right, so I'll just show it. All right, so this is you can see here the OHLC, opening, high, low, close, and then the volume, and then the adjusted price. Okay, so we did this last time, so let's just have a quick run through this. All right, then I introduced you to the concept of using dplyr, the pipe operator, which we said the shortcut is Control Shift M for Windows and Command Shift M for Mac. And the new pipe operator actually looks like, okay, let me just use that. It looks like this. No? It's the pipe and then the greater than sign. This was the old symbol for the pipe operator. It's called pipe because you're able to process, you're able to do some process of your data from one point to another. So the pipe acts as like a conduit. That's why it's oftentimes called and then. Okay, so we start with one data or object, and then we do something about it, and then so it's a continuous process, and it's a lot better than the usual code where you have parentheses, using parentheses, and you start with the inside and you go from the inside out to the up to the outside. So it's quite confusing. But with the pipe operator, it's logically the logical flow is very clear. All right. So from the Apple object, we just want to get the closing price. So Apple close is equal to the Apple object, and then subset it to get the fourth column. And let's show that once again. The fourth column is 1, 2, 3, 4. So the closing prices, we are subsetting the closing prices, or we can use this, once again, we can use the get symbols. The symbols is equal to tick back to the Apple from start to end periodicity double, and we will just get the fourth. Okay, let me see this. All right. So we have here Apple close. Okay. Oops, why didn't it run? Okay, bakit hindi siya nag-run? What happened here? Incorrect number of dimensions. Okay. Do I need to put here the auto dot assign? Did we do this last time, class? False.
Yes, sir.
And
Sir,
then
we did.
were we able to get the answer here? Auto dot assign is equal to false, so that it will give this name. Okay, let me run this again. Okay, I think this is the this is the error. You have to assign it. You have to give it auto dot assign is equal to false. Okay, so okay, let's see. Apple close there. So you only have the closing price. Okay. Okay. Yeah, I think I recall that we were not able to run this. Okay, and yeah, by just looking at it now, okay, I saw that it lacks this auto dot assign. We have to use this because we're giving it another name. All right. So we can actually get weekly prices. These are daily prices by changing the periodicity, and monthly prices, etc. So I hope this is very clear to us that indeed quant mode is very powerful, because imagine before, when I would download prices, I would use Yahoo Finance, and it takes me long because there's no provision for Yahoo Finance. Is there? Okay, I forgot. No? Kung may provision ng weekly or monthly or daily, that was a long time ago where I would use Yahoo Finance. But if I recall right, I was not able to get, or was I? Anyway, so this makes it very, very flexible. You can use weekly or monthly prices. Okay, so if I download this, Apple Weekly, so we'll now have weekly prices for Apple. Okay, and then of course you can make it weekly, Apple Weekly, and then closing. Okay, if you want weekly up closing, and then just subset this. Okay, just like what we did a while ago. Okay. Okay, and then I think I remember last time what we did was to get the day, the start of, what's a trading day for 2015? Okay, let's see. 2015 02. That's a starting date, right? So if we get this date, 2015 02, okay, so that's the day 1, And then if we get the class of that data, it's character, but we can use the lubridate package because lubridate really works well with dates. So we said here that we're assigning day one to day one, which is this one, but we're defining it to be year, month, day. Okay, so year, month, day from the lubridate package, and then we get the class of day one. It will now be as a date, right? So date na siya, no? We have converted it, and then let's see what's the day. So this is a Friday, okay, and this is a Friday. So when we download the weekly prices, okay, take a look at this. Okay. So this is January 2. These are, what's this? This is, sorry, this is daily prices. So let's get the Apple Weekly. Okay, Apple Weekly. Okay, where's that? Apple Weekly, and then let me put here the closing prices, and then just subset this to all the rows and the fourth column. All right, so here I'm creating this object, Apple Weekly, and then just the closing, and then auto.assign. So this is the periodicity of weekly, and then I run this, and then the Apple Weekly close will be, okay, it's still January 1. Okay, so this is what I think I was concerned about last time, because here the weekly price is now it's on a Thursday, because this is a Thursday. But normally, the weekly prices should be, the weekly prices is usually pegged at Friday. So I don't know why this, let me see. Maybe it's okay, why? Let's try to see if this is the starting date of the trade for 2015. So let's change this, because January 1 is a holiday. So the trading started at January 2, 2015. So if I change the date, let me see if, okay, let me see if what will happen to my, okay, it's now 1, 2. Okay, so let me go back here. All right, I run this already. And then, let's see, I'll run also Apple close here. So this is the closing prices, and it starts with January 2. And then let me run again this one. Apple Weekly close. This is weekly prices. And then I'll get the closing price. Let's run it. And let's see. It's still January 1. Okay. I will have to research on that, why it's giving me January 1 weekly prices, even if I already mentioned that the start of the weekly close is January 2. Okay, but it gives me the default of January 1. Okay, so anyway, that's not really an issue to us at this point. Okay. All right, we also got the monthly price. Okay, I hope it doesn't, I hope class, it's okay with you just to have a very quick review of this. Okay, this is the monthly price, and we did not get the closing price, but it's also January 1. Okay. All right. Then we got these stickers. We're going to use this for our portfolio. SPY, EFA, IJ, ES, EM. So these are exchange traded funds. They actually track usually S&P 500. Okay. So we now have this object tickers. It's a vector of characters, and we learned about this very simple function. Okay, So we start with portfolio prices, null. It does not have anything there. And then this is how a function starts. You have here for ticker and tickers. Okay, so we use the cbind, column bind, portfolio prices. We column bind it to portfolio prices. And then we get symbols from Yahoo for ticker. Okay, ticker in tickers. Our tickers is this one. So it will go to the tickers one at a time. All right, from start to end, daily prices, and then auto.assign is equal to false. Don't use the because don't use these names because we're going to give it this name, portfolio prices, and then we're just getting the closing price. So let's run this function. Okay, so you notice we first have portfolio prices null at the start, but it will populate itself. Okay, and then it's now an XTS object containing the closing prices for this portfolio of assets: SPY, EFA, IGS, EEM, and AGG. Okay, so if I show this there, you have the closing prices of these stocks. Okay, so that it's very easy to get a an XTS object containing whether it's opening price, highest price, lowest price, adjusted prices. Okay, it's very easy to use quant mode for that, and we made use of this function. Okay, so we also learned last time that we can easily check for the missing values. So what we do is we use the column sums. Okay, we add the columns. Okay, and we add for those in the portfolio prices that are missing is that NA. And it will give you a vector of sums, okay, for SPY close, EFA close, etc. And they're all zero, which means that we don't have any missing values, which is good. Okay, and we also need, in order to compute for our CAPM, we need to have a benchmark. Okay, I hope you have several subjects already about the capital asset pricing model, which is a model to estimate the value of a stock, okay, the returns of the stock using a certain benchmark. And our benchmark is S&P 500, and this is the ticker symbol for S&P 500. We also use the same thing, benchmark prices. Okay, we used this last time. Get symbols, and then we're also getting the closing price. So we now have here benchmark prices. Here, benchmark prices in our data here. Data benchmark prices are the prices, closing prices for S&P 500. So we now have a market, because usually the proxy for the market is S&P 500. Okay. All right. Now we learned last time it's very easy to compute for prices or for returns. The use of ROC, okay, which is from what package? From technical trading rules. The ROC is from the technical trading rules, and it's simply the rate of change. Okay, or the rate of change is simply also the returns. And we learned that there are two types here: the continuous or discrete. So we have to identify what type. Discrete is simple returns. Continuous is for log returns. And if you don't mention anything, if you don't define what it is, the default will be, okay, continuous. Continuous, which is the default. So if I don't type this, it will compute for the continuous returns or log returns. Okay, let's run this. Okay, then we have now benchmark returns here. Okay, so this one. Benchmark returns for, this is for, of course, this is for S&P 500 because we're using benchmark prices. Okay, let's just validate benchmark prices. Okay, benchmark prices. So for January 2, it's 2058. For January 5, it's 2020. So we can get the discrete returns. Control C, control. Okay. Oh, wait. Okay, wrong. So it's, let me just type it, 2020.58. Okay, divided by 2058.20. Okay, so it's the price at time t minus, divided by the price at time t minus 1 minus 1. This is your discrete returns or simple returns. Okay, control enter. So we have negative 1.8, and let's see the benchmark returns negative 1.8. Okay, 1827811. Okay, so we're okay. Okay, we were able to show that that this is your benchmark. This is your simple returns. Now, okay, so what do we have here? For our benchmark returns, okay, nag-automatic siya na tinanggal yung 1, 1, ano? Okay. So, but if it appears, class, if the first one appears, then it will be 0. And some will write NA. So 0 siya. Okay, yung benchmark returns natin, 0. Then you can just remove that by subsetting it. Okay, benchmark returns is ROC of benchmark prices type is equal to discrete, and then just remove the first element there. Okay. Or we said that we can use the omit and NA dot omit. Okay, discrete. All right, any questions here, class? Sorry to be spending a bit of time for this, for a quick review. Any questions? Clear ba tayo so far? Okay. I don't think it's it will hurt for us to have a quick review of this. None. Okay, good. Thank you. All right. So,
Sir, ako very quick lang.
yes, sige. So,
Ano ibig sabihin, sir, ng discrete? Dun sa type equals
yeah,
discrete.
discrete means this is your simple returns. Simple returns. Okay? So,
Okay.
diba, ang definition ng simple returns is the price at time t divided by price at time t minus 1 yung previous minus 1. Okay? It's from the from getting the percentage change, diba, yung by definition the percentage change is value now minus value before, or new value minus the old value divided by the old value. That
So sir, it's performing a formula in short.
Yes, oo. Yeah, itong function na to ROC. Okay, this is a function which performs that formula. Ano yung formula na yan? Price at time t. The long formula is what we learned is elementary. Is the price at time, the price new or the value new minus the value old, and then divided by the value old. Okay, ito yung natutunan natin nung elementary tayo to get the percentage change. But of course, we learned that the better formula, especially when we're using Excel or function or softwares like this, is not to use this, but just distribute this. So this becomes price at new divided by price of old, and then minus 1, kasi price of old over price of old, that becomes 1. Which is now your simple returns, aka discrete returns. Okay? So pareho lang,
Yes, sir.
pareho lang yun, pangalan lang nagkaiba. But it's technically, it's really called discrete or simple returns. All right. So, and the function is ROC. No? Thank you for that question. Thank you. I appreciate questions like this. Okay. So nag rate of change. This will give us the returns. Kailangan natin returns kasi that's what we're going to model. What is usually modeled are not prices but returns. Okay? Sa CAPM, di ba? Minomodel natin dyan yung returns. All right, so this is another way to do it. We just remove the NA. I'm just surprised that dito, hindi lang tanggalin ko lang ulit yung ano. Let me remove RM, remove the benchmark returns. So tanggalin ko muna siya. Okay. So wala nang benchmark returns ako dito. No more benchmark returns. May benchmark prices. But let me run this. I-run ko nga to. Kasi dapat I'm expected to see a 0 dun sa unang line. Kasi wala siyang wala siyang previous na na value, wala siyang previous comparator, no? If I run this, all right? If I look at ayun, benchmark returns, meron na siyang 1 2. So ito meron na dito. That's why meron na siyang NA dito. That's what I wanted to show you a while ago. Kasi biglang hindi ko alam kung bakit siya nagsimula sa 105. So usually we will have this. So if you have this, you can just subset it and remove the first line. Or pwedeng dire-diretso na dito. To compute for the benchmark returns, just include this NA.omit. Kasi what it will do is that if there's a NA value at the start, then bakit nagkaka-NA value at the start? Kasi wala tayong wala tayong previous na okay, we don't have this. We don't have 2058 divided by the previous one. Wala tayong prior price in order to compute for the rate of change between January 2 and the previous December 30, December 31 of 2014. Okay, kaya nag-NA siya dito. So we can just that can give us trouble if we don't remove that. Baka sa mga operations mag-error tayo kasi kunyari, if you get the average, sige ang benchmark returns ko, okay, may 1, ito pa rin siya, no? May NA. If I get, let's say, I'll just get the mean of benchmark returns. If I get that, the mean of that, okay, nag-NA siya, no? Sometimes it will return an error term. Ito, nag-NA siya. Bakit NA? Di ba may mga values naman to? Kasi may NA value siya dito. No? So, it's R gives this as a signal that there's a missing value in our vector. Okay? Or XS object pala. Okay, so in order to avoid this, kailangan tanggalin natin siya. Either this one, sa subset natin, tatanggalin natin first row, or you can just use this. Benchmark returns NA.omit. Okay, so you can see here that wala na yung missing value sa first row. Okay. Now what we usually use is the the log returns. Okay? And then may reason kung bakit ito yung ginagamit. Mas kasi let's say quote unquote powerful, mas may practical use yung log returns. Okay, so let's use the same formula. This time let's call it benchmark returns underscore log and then rate of change ulit, but this time the type is continuous, or we can remove this. Kasi pag wala ito, okay, compare natin Let me copy this, Control C, and then Control V, just to validate. Tatanggalin ko si type. Okay. So if you're using ROC, rate of change, and if you don't write the type, it will default to a continuous. And there's a reason why continuous yung dini-default niya kasi mas ginagamit talaga siya sa finance. Control Enter. All right. And then we can see here that the benchmark log prices is okay, negative 1.844. Okay. All right. So let's just make it 1 here para mo-compare natin. Okay. Okay, yung 1 natin. Okay. Or maybe I can just then I'll delete this later. Just get the head of benchmark returns log. Okay, let's give it 10, the first 10. And also this one, head ng benchmark returns, benchmark R returns log 1. And I'll also ask for the first 10 values. Compare lang natin just to validate class kung pareho nga yung if you don't write continuous or you write continuous. Okay. 1.8 18447213, okay, exactly the same. Okay, so we were able to validate that it's the same. If you don't type continuous, it's okay. All right, so let me just delete this. Okay, let's go back now to our portfolio of stocks. Iba yung portfolio prices natin, what does this contain? Ito yung ano, yung mga natin, yung mga SPY, EFA, etc. Okay? And let's just replace it. Let me just close some of this kasi masyado na marami nakabukas. Okay. So I'm closing. Dami nakabukas na ano na dun sa view. Okay. All right. So what are we now doing here? Okay, di ba yung tickers, it's an object. It's a vector consisting of the names, yung pangalan ng mga natin ng dinownload natin na prices. So we can use the column names. Okay, column names of the portfolio prices vector or XTS object. So in portfolio prices, no? All right, and it contains, as we mentioned a while ago, this one. So papalitan natin yung column names nila. Gawin lang natin yung tickers. So in other words, matatanggal dito yung mga close, close, close. All right, so let's run this. And then, so our portfolio prices now become, okay, natanggal na yung mga close. No? All right. Okay. Now, again, let's see if there are there missing values in our object portfolio prices. Okay, so nothing. Okay, nothing because why are we doing that? Because if there are missing values, we have to check that, and we have to time series kasi to, no? So it might be wrong to just delete that. And there are processes called imputation. The imputation process gives a value to missing values. So there are several ways to do this. You can just get the median and replace the missing values with the median. Or you can get the average. Okay. All right. Mas sensitive nga lang si mean or average dun sa mga extreme values. No? Ang median, walang pakialam sa mga extreme values. Basta yung pinakagitna. No? Yun lang siya. All right. So, okay. Here. All right. I think we ended here. So we i-plot natin yung portfolio prices. Lagyan natin ng legend sa top left. And then let's, yung column names, and let's give also index ng column names portfolio prices. So let's run this. Oops. Portfolio prices. Bakit not found? Error in...
Sir, capital P, small p.
Ay, okay, sorry. Yeah. Oh, sorry. Thank you. Yeah, mali. So dapat small p, yung prices capital P. Yeah, very good. Thank you. So, tama ba dito? Portfolio prices. Ipa-plot natin siya. Lalagyan na natin ng legend sa taas. Tapos lalagyan din natin ng parang index yung mga names ng mga portfolio prices. Let's run this. Right. It will run now. Okay. Wala yung index ah. Hindi ko nalagay. Alright. So we have these 5 prices. This is your SPY. And let me see. Legend ng performance, mahaba eh, no? Okay. I would want to put on a legend sana, no? Kaso, so anyway, wag na lang muna, no? So this will require, it's better to do this using ggplot2, but we're not using ggplot2 now kasi that will entail another long topic, long discussion on plotting. But so ito yung mga plot ng mga prices natin, no? So you can see here that yung galaw niya kasi 2015, no? So this is way past the global financial crisis ng 2018. So there was a downward trend. Consistent naman sila lahat dito. During the start ng pandemic to, no? Yung pandemic, and then slowly recover siya. And then it actually did not go down below the 2015 prices. Hindi naman siya bumaba ng ganun, below the 2015 prices. And then it recovered, and then nung I think 2022 na to, no? Medyo it reached a peak. Now, in the succeeding lessons, pag-uusapan natin yung mga indicators. For example, RSI, no? Relative Strength Indicator, MACD, the Moving Average Convergence Divergence, EMA, Exponential Moving Average. Now, tanong ko lang, class again, I need your feedback. Have you learned to compute for this in Excel muna, no? So we will show this first in Excel para may appreciation tayo. Kasi pag minsan, pag nasa R lang, hindi natin nakikita kung how it's done, and it's easily to forget pag ganun eh. But once the advantage of doing this in Excel first, you get to see what's happening. So when you now use PTR, technical trading in rules in R, we have already a concept, we have already an understanding of what's happening at the back of the function, like add Bollinger Bands. So these are the next lessons when we look at indicators that's used for stock trading. So this is, diba? This is trading software, no? So we will learn how to compute for this very common indicators. We first use this. We first use Excel, and then we go to R. Okay, you haven't answered my question, class. And one of you have used at least Excel to compute for RSI, MACD, Bollinger Bands. May subject ba kayong na-discuss nyo na yun, technical trading indicators?
Na-touch namin, sir, ng konti. Not very deep, pero like, what it does, para saan siya, medyo, sir. Hindi namin kinompute, parang ano lang yung meaning.
Ano lang kung paano lang ginagawa, no? Kung paano lang yung broad meaning niya, no? Right?
Yes, sir.
Okay, but here, we need to at least know how it's being computed. So we'll have siguro mga at least, at most siguro 10 indicators. And then we will use Excel first. Madali lang naman sa Excel yan. Tapos makikita natin kung paano ginagawa. And then we move on to R. All right. Okay, so let's go back to our codes. Okay, now, how do we compute for the portfolio returns? Ano ba natutunan nyo sa investment o portfolio management? Tapos sa kayo ng portfolio management, di ba? Right? Am I right, class?
Ako, sir, yes.
Sir.
Yes, you're taking it now. Okay, so
Yes,
the
sir.
formula for the portfolio returns is R sub P. Diba? Okay, let me increase that. R sub P is equal to, naalala nyo ba? Just the weighted sum of, ito lang, no? So you have your asset, the return of the asset, average return of the asset, and you have the weight of the asset in your portfolio. So if you have 5 stocks, so I, of course, ranges from 1 up to the number of assets in your portfolio. So this is your return of the portfolio, which is just the weighted sum of the individual returns of your individual assets. Okay. Now, mas mahirap yung portfolio risk. Huh? Can anybody tell me what the formula for portfolio risk is? Dinidiscuss na ba yun sa portfolio management nyo? Anyone?
Not yet, sir.
Sige.
No
Anyway,
idea, sir.
no idea. Kasi ang importante sa atin, optimization tayo, no? That's what we're doing here. We would like to learn how to optimize a portfolio. So optimization means when you optimize something, you either you have a set of objectives or you have an objective. When you optimize something, you either maximize something, and of course, it can be maximizing your returns or minimize something. What do you minimize? The risk. So we need to know how to measure the risk. And the risk is measured by, so it's a measure of your standard deviation or your variance. Variance of your portfolio is equal to, okay, so I don't know if you have met this formula, but okay, it's your summation of your summation again, double summation of your Wi, Wj, covariance of Ij. Okay, so that's the formula. No? I ranging from 1 up to n, the number of your asset, and j 1 up to n. Okay, so this is the variance of your portfolio. If you want to get the standard deviation, of course, you just get the square root of this. But the variance is equal to this one, and the standard deviation is just the square root of this. This thing, what is this thing? My double summation. Na-meet nyo na ba tong formula na to, class? Yes or no? Honestly. Na-meet nyo na yan eh.
Parang hindi pa, sir.
Hindi pa?
No,
Talaga?
no.
No? Talaga? Oh, I'm surprised, ha? Dapat, ano to, yung staple discussion to. Anyway, sige. Anyway, na-discuss naman natin, no? So, it's a double sum. Let me just, sige, while we're here, let's just take a look at what is the risk of an two-asset portfolio. Okay? So, two-asset portfolio, madali lang yon. Ang gagawin natin, i-prepare natin yung summation natin. So, let's start first with I. So, I here refers to, kasi kukunin natin pairwise ng assets natin. So, kung dalawang asset lang, okay, so I will refer to asset 1 and J will refer to asset 2. So, how do we do this? So, first, asset 1, okay? So, it will be 1 paired with 1. So, that's asset 1 paired with asset 1, okay? And then asset 1 paired with asset 2. And then asset 2 paired with asset 1. And then asset 2 paired with asset 2. Ganun lang siya. No? Okay? Two assets lang naman eh. So you have asset 1, asset 2. So you perform this double summation. Asset 1 with asset 1 with itself muna. Asset 1 with asset 2. Asset 2 with asset 1. Then asset 2 with asset 2. If you have three assets, then magiging ano na? 1 with 1, 1 with 2, 1 with 3, 2 with 1, 2 with 2, 2 with 3, and 3 with 1, 3 with 2, and 3 with 3. So you notice that the more assets there are, the more complicated is the computation for the variance of the portfolio. And well, it's logical kasi mas maraming assets tayo. No? Okay, so let's just discuss very quickly kasi we will not be computing the variance today, but we'll be computing the variance next meeting. Okay, so it's good for us to know this already. So the return of the portfolio is very easy. Ito lang. So if you know the return of the asset, kaya nga kinocompute natin tong ROC. Dapat alam natin yung return ng asset. And you know the weight of the asset, then that will be very easy. So if you have a 5-asset portfolio, weight ng 1, return ng 1, plus weight ng 2, return ng 2, plus etc. weight ng asset 5, return ng asset 5. So very straightforward yung returns. No? Walang problema. Ang medyo challenging yung risk ng portfolio. So for a 2-asset portfolio, the formula will become like this. No? So we will replace this with 1 and 1. Okay, so that this will be W1 and W1. So what's W1 and W1? That's W1 squared, diba? Right? And this one will be, this is the covariance. No? So you notice, hindi siya variance, covariance. Dalawang subscription, I and J. Covariance. You're getting the variance, the relationship of the one asset with another asset. So if this is sigma 1, 1, the covariance of asset 1 with itself, then this becomes just the variance. So sigma 1 lang yan, and then squared 2. It's just the variance of 1. Yun lang yun. Oops. What happened here? Okay. So yung 1, 1, ano lang yan? Weight ng 1 squared. Okay? Yan. Weight ng 1 squared times the variance of 1. All right, let's now go to the next pair, 1, 2. So this becomes weight ng 1 times weight ng 2, okay, multiplied by covariance 1, 2. And you write covariance 1, 2 with this one, 1, 2. Okay? Notice walang squared siya. Okay? There's a difference between the variance or the covariance of asset 1 with itself. You denote it as sigma 1 squared. Yung covariance naman is covariance of 1 and 2. The formula are quite similar, no? If you recall, ano ba formula ng covariance? It's your asset x minus the mean of x times asset y minus mean of y, diba? And of course, you sum this up and then divided by, depende kung sample or ano, divided by n or n minus 1. So depende kung sample or population. Okay, ito yung covariance. So when you're getting the covariance of x with x, and magiging ano lang yan, di ba? Magiging squared lang yan, magiging variance siya. Okay, I hope, well, that's a quick review of your stat. And then yung susunod naman, 2 with 1. So 2 with 1 becomes W2, W1, covariance 2, 1. And the covariance of 2, 1 is just the same as the covariance of 1, 2. Okay, kasi ito yung formula na yun, di ba? It doesn't mean kung mauna si y minus y bar kaysa sa x minus x bar. So it's actually the same. It's the same. It's this one. So we can put here 2. Okay? And the last one is, so tapos na tayo sa 1, 1, tapos na tayo sa 1, 2, tapos na tayo sa 1, 1 ito, no? And then 1, 2, yung kanina. And then 2, 1, ito yun. So dalawa. Same kasi siya. So 2 times that, no? And lastly, 2, 2. So your 2, 2 will be like just, it's W2, W2, sigma 2, 2. So that will be W2 squared times sigma, or the variance of 2. All right? So actually, the variance of a two-asset portfolio is just the squared weights of the variances of the portfolios. Okay? Squared weights ng variances nila, variance ni 1 and variance ni 2, plus ito, the cross product of their weights multiplied by their covariance times 2. All right, so this is the risk sigma squared as measured by variance of a two-asset portfolio. Okay, and then it can easily be shown that yung three-asset portfolio will be may W sub 3, sigma 3 squared. Plus magkakaroon ng pairwise, no? 2 W1, W2, mayroong 2 W1, W3, mayroong 2 W1, W2, W3. So ganun, yung three-asset portfolio. All right, so let me pause for a while. Are there any questions? Now, I'm discussing this because this is portfolio optimization, and then we're going to use this on Wednesday when we formally compute for the risk of a portfolio, either based on variance or the standard deviation. Kasi yung standard deviation, kukunin lang naman natin square root. Okay, kindly chat please if so far clear tayo yung pag-compute ng portfolio returns. I should have been discussing this later pa, no? Kaso andito na, so sabi ko, sige, baka hindi tayo umabot ng time, baka hindi ko ma-discuss to. So let me discuss that. Okay, Rob, thank you. How about the Rose? Tim, okay ba? Okay. Rose, thank you. How about Tim? My questions?
None, sir.
Okay, clear, ah? Clear? Don't be ashamed to ask questions, class. Huwag kayong mahiya. Tayo lang dito. Okay, so let me, okay, clear this. Clear all drawings. Okay. Any masters in finance, dapat, dapat alam na alam natin yan. So, without even thinking, dapat masasabi natin ano ba yung risk ng portfolio, 2 asset, even at 3 asset portfolio. So dito, kailangan natin i-mention yung weights. No? Kasi if we're going to compute for the portfolio returns, we need to have, di ba, ang formula natin, WI, R sub I, yung summation nun. So we need the weight of the asset, we need the return of the asset. Okay. All right. Meron na ba tayong returns ng asset? Complete ba natin stock returns? Okay. Let me, balikan ko lang ha. Stock returns. Di ba natin complete ha? Okay. Did we miss out on something here? Benchmark returns. Ito. Yan. Ito. Hindi pa pala natin complete ko. Ito to. Sorry. We missed this out. Kaya nagtataka ko bakit wala pa tayong returns. Meron tayong returns ng, okay, let me explain. No? We have the returns of your benchmark returns. Ito yung benchmark returns natin. GSPC to, no? Okay, yung asan yung assets natin? Okay. Benchmark prices natin. Benchmark pala, sorry. Asan yung natin? Yung portfolio prices. This one. Alright. Ito yung prices natin, di ba? Wala pa tayong returns nito. The returns that we computed is only your benchmark. It's only your GSPC. So we don't have yet the returns for this portfolio prices. So compute na natin yung returns niya. Kasi ito yung natin, ito yung portfolio na gagawin natin. We have 5 assets. So how do we compute for the returns, the return of the portfolio? Ang portfolio natin itong 5 asset na to. Well, we have to know the individual weights. No? Ano yung weight ni SPY, EFA, at saka ano yung return ni SPY. We only have the stock prices, so we need to compute the returns of SPY. So that's what we're going to do now. All right? So, ito. No? Okay, mali yung spelling ko dito. Stock returns, stock returns natin, let's call it stock returns, is the return, dapat nga gamitin natin dito, portfolio returns. Okay, sige, gamitin natin class portfolio returns. Portfolio returns. Just to be consistent, kasi portfolio prices. Sana kung ginamit natin dito, stock prices, then mas maganda, no? Kung okay lang na stock returns tayo dito. So just to be consistent, let's use portfolio returns, and it's equal to the rate of change of your portfolio prices. Okay? And we use the continuous. Okay, and NA that tatanggalin natin yung unang-una. Okay, so let's run this. Run. Okay. If we have this printed portfolio returns. Okay. Ano nangyari? Okay. What happened now? So, ito na yung mga natin, no? Ito na yung mga returns ng portfolio natin. There. Okay, per day, no? So, those are the returns of our portfolio on a daily basis. Kasi, di ba, ang stock natin daily, no? So, what we will have now is daily returns. Okay. All right. So, I think we're missing something here as natin. Yun ang portfolio returns natin. Okay. Okay. So dapat papalitan natin to. Ay, hala, ginamit ko dito portfolio returns. Okay. Okay, so change na lang natin to, no? Medyo maraming mababago class, no? Wait, sige. Let's see. Let's see what's the best name we can. So ginamit natin portfolio returns. Okay, so dito calculate natin yung portfolio prices. Okay, let me revert back to no? Stock returns na lang ulit dito. Sorry about that. So gagamitan ko ulit ang stock returns, no? Okay, so that I still maintain the portfolio returns. All right, so let me run this again. Okay, yung stock returns, ito. No? Natanggal na yung first day kasi NA yun. All right, then, okay, ang weights natin, let's make it equally weighted, no? Equally weighted. So, paano yung equally weighted natin? Okay, tingnan natin portfolio prices, no? So, we have here 1, 2, 3, 4, 5. 5 yung ano natin, 5 yung assets natin sa portfolio, no? So, ngayon natin na n stocks natin. How many stocks do we have? It's the number of columns of our portfolio prices. Hindi column. Column and stocks. Okay. Ilan yung stocks natin? So, let me print 5, di ba? So, okay. All right. Hindi, wait hindi, kinolom sum, hindi. Wait, hindi and call, okay. Error, wait. Hindi sorry medyo ako sa medyo long day na talaga, no? Okay, for now, let me, medyo parang nalolobat na ako, no? All right, so for now, let's do this. We're going to give the weights. So let's make it, i-repeat natin. Let's use the repeat function. Rep. Okay, so rep ng so ang weights natin will be 1 divided by 5, right? And then how many times? 5 times. Okay, what are we doing here? We're creating this object weights. Tapos una, ang mo natin equally weighted. So this is the most simple. Equally weighted. Of course, we can give it different weights. So let's assume that the weights of the assets are equally weighted. So if we print this, lagyan ko na lang dito ng parenthesis para ma-print siya. Okay? So let's print that. Okay, di ba 0.2, 0.2, 0.2. No? Okay. Equally weighted. No? Remember, class, if we're going to compute for the returns of the portfolio, we have to define yung yung weights niya, no? So here 0.2, 0.2, 0.2, 0.2. So bawat isa sa kanila 0.2. And then let's compute for this. Okay, the portfolio returns will be equal to the function return of the portfolio. Okay, so tingnan natin yung function na yan. Okay? Wala pa kayo nito, di ba? Hindi natin inabot to, di ba? Right, class? Am I correct? Did we reach up to this point last time?
No, sir.
No? Okay.
No, sir. Ngayon pa lang.
Alright, sige. Yeah, I think this was the one I used in the others in another class. So ito, no? So just kindly write this, no? Yung weights natin is, i-repeat natin 1/5. How many times? 5 times. So we need to have 5 weights kasi 5 yung assets natin. And then this one, we're going to make use of this function, return that portfolio. Let's see what this will give us. No? Return that portfolio. Okay, so this will be coming from performance analytics. Nasaan na siya? Help. Hindi, ROC yan eh. Ah, imposible. But no documentation. Maya pala eh. Again, naka-capital yung portfolio ko. Sorry. Return that small p. No? This is coming from the performance analytics package. Yan, okay. Performance analytics package. So what does the return that portfolio give us? Okay, it calculates the weighted returns for a portfolio of assets. Okay, so using a time series of returns and any regular time series of weights for each asset, this function calculates the returns of a portfolio with the same periodicity of the returns data. So ibig sabihin, dapat kung daily yung data natin, dapat daily din yung returns natin, no? Okay, so we're calling it portfolio returns, okay? And we're using the return that portfolio. So we have to identify kung ano yung stock returns natin and then yung weights natin. Our weights, okay, is equal to the weights dito. Okay, if you're confused with this, pwede natin gawing WTS lang to, no? Okay, so I'm creating this object, WTS. All right? So our weights is equal to the vector WTS. There. So sige, i-run natin to, this code chunk. All right, so what do we have now? And let's take a look at return portfolio returns. This one. Okay, so what do we have here? Anong nangyari dito, class? Di ba meron tayong, okay, meron tayong returns ni stock returns natin. Asan? Stock returns ito. Ito yung mga returns nila, di ba? Returns. Returns ni SPY, EFA on January 5. So, ang portfolio return natin will be, each one of this will be multiplied by times 0.2 times 0.2 times 0.2 times 0.2 times 0.2. Okay? So, pag times, or in other words, we just get the average of this, divide by 5. Kasi multiplying it by the same weight is just getting the average of that. Divide by 5 or 0.2 each. So now we have this vector portfolio returns. Yun. Okay, so this is just the, as I mentioned to you, this return times 0.2 plus this return times 0.2 plus this return times 0.2, etc. So this is now our portfolio returns, daily returns ng portfolio natin. Okay, let me pause for a while and allow you to, if you haven't copied the formula, if you haven't written the formula, and check your output. And if you're done, class, kindly chat, please. Now you're okay. Hmm. Kindly chat please, class, if you're done. If you're able to get this answer ng portfolio returns. So it's a daily return. However, it has only one return kasi we're combining the returns of our assets in the portfolio by multiplying their individual weights, which is equally weighted 0.2 multiplied by their specific returns. So we get this. Did you get it, class? Any questions?
No question, sir.
No questions? Sige. Yung iba? No clarifications? Dun sa pag-compute natin ng, okay, let me see. Alright, thank you, Rose. Okay, Rap, may question ba? Tim, may question?
No, sir.
No? Okay, alright. So we can actually plot, no? We can use this chart that cumulative returns. So let's see what this function does. It's always good. Kopyahin ko na lang para mas mabilis. This one. What does this function give us? So this is also from, oops, kamali na naman yata ako. Kamali na naman yung spelling ko. Returns dapat. Okay. Cumulative returns. Okay. Chart.cumulative returns. All right. This is also again from the performance package. Okay. So what does this do? Cumulates. Pag sinabing cumulates, ina-add up niya, no? And graphs a set of periodic returns. Right. So this is the complete function. Okay. So, Tim, mute lang kita. Okay. So, and then we can also have this, no? Iba naman to, yung charts.performance. That's why I like performance analytics so much kasi ang dami niyang talagang features, ang daming natin pwedeng makuha out of it. No? So let's just first run this. So this will give us a chart of the cumulative returns. Okay, so take a look at this. Okay, cumulative returns to, ah. So you start here, and then you add the returns. You notice there's a well, in parang sa time series, meron tayong tinatawag na ng volatility clustering. So you notice na may mga seasons na
Ako naman sumasama ako sa market season eh.
Tim, mute lang kita. Okay, so yung volatility clustering, di ba? Yung volatility shocks o volatility clustering sa time series, sa returns, no? It depicts that seasons of increases in returns will followed by increase in returns. Parang may mga domino effect na increase. And then pag decrease, tuloy-tuloy naman yung decrease, no? So that's what we call volatility clustering. Kaya nga, I don't know in your time series if you discuss that yung modeling using GARCH. Okay, pero ito kasi cumulative to eh. So usually hindi ginagamit yung GARCH kapag cumulative returns. Dapat siya, yung actual na returns. All right, so we can see here the yung if we keep on adding the returns, ito nangyari. So these are seasons of continuous returns. Tapos makikita natin dito, we can see here that ito yung COVID to eh. Kita natin dito. Kita natin yung
Naka-earphones ako isa lang. Ba't naka-earphones isa? Bawal.
Tim. Okay, sige. Thank you, Tim. All right. So, okay, let's now go here. How about this one? Yung performance summary ng portfolio returns natin. Okay. All right, so let's take a look at this, no? Okay, I'll leave you, class, to, this is your daily returns. This is your cumulative returns. What is drawdown? Okay? What is drawdown? So, alamin nyo kung ano yung drawdown na kasi babalikan natin yan next time. Ito, na-explain na natin, cumulative returns. No? Ano naman ito yung daily returns? Okay? Ito yung sinasabi ko sa inyo na volatility clustering. And this one. This one. Yung seasons of high prices will continue to have high prices. Ito yun, no? This periods here. Medyo dito. But ito, apparent siya dito. Talaga nagkaroon ng volatility clustering dito. Okay? Because of the COVID, of the pandemic. Ito. January siguro, ano to? January. First month ng COVID pandemic. But you can see here the effect. But it will be a good study if this is attributable to the COVID pandemic. All right. So that's our chart performance. So tatlo yung plots na pinapakita na sa atin. Charts that performance summary. All right. So we have some more topics here. Okay. Let's now compute for the beta, for the Jensen alpha, and for the Sharpe ratio, and then we'll end here and then go to the next file. We will start with the next file. Okay. So let's assume that the risk-free rate is at 3.5%. Okay, 3.5% yung risk-free rate natin. So that's 3.5% or 0.35. Let me just use decimal 0.035. And then the trading days per year is 252. Now, kasi daily returns tayo, di ba? Ito, annual returns to, yung 3.5. So we will have to convert that into daily returns. Kasi yung mga returns natin lahat, daily. Alright, we can now compute for your beta. Meron tayong beta, regular, beta bullish, and beta bearish. So that's taken care of, yung CAPM, yung capital asset pricing model. So anyway, let's take a look at, let's take a look at CAPM. And then, beta, CAPM beta, bear, and beta bull. So let's first take a look at the CAPM beta. So this is from Performance Analytics. So single factor siya. Kasi may double factor, may in computing for the returns of the asset. The single factor model, or CAPM beta, is the beta of an asset. Beta of an asset to the variance and covariance of an initial portfolio, and it's used to determine diversification potential. So you can see here my sample. You can run this example. Pero punta na tayo dito sa ano natin. Okay. Sige, tingnan natin to. Let's just look at this, no? Let's take a look at what data managers is. So let's run this. I haven't run this example. Let's just see what data managers is, and then let me view this. Alam ko na to. Okay. Ano to yung portfolio ng ano? Okay, yan. HAM1, HAM2, HAM3. Okay, this is a portfolio from monthly portfolio to, no? From 1996. Returns to. Hindi ko lang maalala kung ano yung ibig sabihin ng, but we can. Okay, pwede nating tingnan na lang yung definition muna just to understand what this managers natin. All right. Managers. Hindi. So dapat hindi siya, dapat data siya, no? Data. Let me see. Or isang ba siya? Okay. Let me do this. Performance Analytics. Okay. Manager. Managers in data. All right. So here, it's kaya ang tawag sa kanya yung HAM, no? Hypothetically Alternative Asset Manager and Benchmark Data. So it's an XTX object containing columns of monthly returns for 6 hypothetical asset managers. HAM1 to HAM6. Tapos meron tayong long, short, equity, hedge fund, etc. Okay, so ito yung data, no? Ito yung mga returns. Okay, so we can compute here for, dito ang kinompute lang niya yung cumulative, yung tail lang. But let's go back to our, isa na yung ano natin. Ito. Okay, let's go back to this example. Ito yung data natin, no? And then, alpha to, no? Let's take a look at the beta. Cap M beta. Okay, for HAM2. Okay, drop is equal to false. Managers, ito yung benchmark natin. RF from the managers, US 3-month treasury rates. Okay, medyo may mga data dito na na we need to understand what they are. But let's just compute for this. Control V. All right. Enter. Okay. So this will give us the beta. Okay. And what did you learn about the beta, class?
I can't do it my explosion.
If it's 1, sir, it's behaving the same as
The market, no?
the market, yes.
Yes. But if it's less than 1, like this one, 0.33, it means that is it as risky as the market? Is it as volatile as the market? Hindi, no? 0.33.
Less volatile.
Less volatile than the market. Let's compare now kung bullish siya. Tingnan natin. Kasi pag bullish, ang hinahanap yung mga matataas yung mga returns. No? Control C. Control V. Okay, let's look at the bullish. Okay, tingnan nyo. No? Mas mataas yung beta niya, 0.522. Yung regular, 0.33. So ang hinahanap, pag bullish, ang ginagamit yung mga matataas na returns. Pag bearish naman, okay, Control C. This will be lower than the regular. Control B. Okay, so 0.06 lang, no? Yung beta niya. So you can see that kapag bearish, di ba? Ibig sabihin nun, very dump or depression market. So it's not, ang bearish beta niya will be a beta that's almost not moving relative to the market. Ang bullish niya, 0.5 here, half as volatile as the market. Okay, yung regular naman. So there's a way to compute this kasi given the returns, kinukuha dyan yung mga negative at saka matataas na mga positive. No? So that's how you compute for the regular, for the bullish, and the bearish. Okay, so did you study this before, class? Ano nyo? Hindi ba? Hindi rin? Okay.
Yung beta lang, sir.
Pero yung function na to, hindi, no? Pero yung
No, sir.
bearish at saka bullish na beta, hindi rin. Alright.
Hindi rin po.
Sige. So now you're aware that there's such the presence of a bearish beta and a bullish beta. Okay, so dito, let's now define na ba natin yung RF natin? Let's assume this is 3.5. The trading days is 252 days per year. And we will now compute for the daily beta natin, no? Kasi yung returns natin dito beta daily. Yung dun sa example natin, these are monthly, no? Monthly values ng data ng beta to. So we will divide yung risk-free rate natin by the number of trading days. So this becomes now your daily rate. Your portfolio returns is your daily returns. Now, ibe-benchmark natin yan. Parang mangyari dito, parang regression siya. You have your Y is your portfolio returns. Your benchmark is your S&P. This is your x-axis. Okay, so compute natin to. Okay. Benchmark returns not found. Bakit?
Sir, yung spelling ng returns, baliktad ang NF.
Ano ba yan? Grabe. Sorry, I was writing this nung grabe, ano na talaga. I'm not, sinasabi ko lang guys, yung my day-to-day is, I had classes 8 to 11, almost 11:30 yun. and then another class at 11:30 to 2:30, and then a meeting at 2:30 to almost 6, no? And then this one. So, ang saya-saya, no, ng araw na to. Okay. Pero hindi naman ako mukhang ano, di ba, guys? Hindi naman ako mukhang dugyot mag-explain.
You're good, sir.
Thank you. Thank you. All right. Ay, sorry, anong ginawa ko? Kanina na mali-mali na ginagawa ko. Okay. Let me run this again. Okay. So what's our, ayan, ang regular na CAPM natin is 0.76. So this is how our portfolio is behaving in relation to the market. Our market is, ano ginamit natin na market? Diba si S&P 500, si JSPC. All right. So let's compute for the CAPM. Dapat lalabas yung ano, para hindi ko na i-type. CAPM, yan. That, let's start with the bull. No? Beta, that bull. So we expect this to be higher than your ordinary regular beta. So let me copy this. Control C, and then Control V. All right. So our CAPM bullish. Uy, interesting. No? Usually, class, kapag bearish yung ano, beta natin, it should be higher than your regular. Okay? But ngayon lang ako nakakita na ang bullish na CAPM is lower than the regular. Okay, Control D. Ano ko nga yun, explore kung bakit ganyan. Alright. Yung bearish natin, okay. Tama ba itong ginagawa natin? Trade days. Am I correct? Tama naman. Now, bakit? Alright. Something's amiss here. No? So if you take a look at this class, wait. Okay. So, mukhang mali yung ano, yung understanding ko ng bearish nila. Okay, but sige, let's keep this because I just like to check, no? Kasi ang understanding ko kapag bullish, di ba? Kapag bullish yung market, ano nangyayari? Are your returns as kapag bullish, siyempre, mas ano no, mas it should be as more sensitive relative to the market. Okay, as compared to bearish. Pero okay, kasi okay, now I know. Ang bullish at saka bearish kasi dito, ang tinitingnan natin dito yung days na positive yung returns. Yung regular kasi, it considers both the positive and the negative returns. Kapag bullish, it just takes a look at the, okay, so sorry, let me, I stand corrected, no? It doesn't mean na kapag bullish, mas mataas laging returns. Mas mataas lagi, not the returns, but the beta. But the volatility of the rate returns to the market. Kapag bullish kasi, ang kinukuha lang natin yung mga positive returns. Kapag bearish naman, yung mga negative returns. So this tells us that yung days of negative returns, okay, mas ano siya, mas sensitive siya to the market kaysa dun sa times na bullish yung market. Remember, this is being computed. Nag-ano to nagre-regress. Rene-regress natin yung mga returns ng portfolio dun sa benchmark returns. Okay? Comparing the positive returns and the negative returns. Okay. All right. So the next, so let's just finish this, yung alpha, Jensen's alpha. So I gave you already the definition of what Jensen's alpha is. Jensen's alpha is just the parang premium to, no? Ito yung excess returns compared to the CAPM. Diba kasi kapag CAPM, we're going to compute for the expected returns using CAPM. Si Jensen's alpha will give us the excess returns. Okay, so if we take a look at how, it's important for us to take a look at the how the metric is being performed, because sometimes magkakaiba sila, no? Minsan iba yung paggamit ng package dun sa formula ng Jensen's alpha. So ito, so again, parang nagre-regression lang tayo dito, no? The Jensen's alpha is the intercept of the regression equation in the CAPM model. Okay? So annotate natin ulit. So what's happening here? Okay. Andito yung market returns, which is your S&P 500. Itong returns niya. Ito yung portfolio returns natin. Returns ng portfolio. Okay? So we plot them. We plot, no? Yung regular, yung lahat. Okay, and then we develop a regression model. Yung regression model na yan, yung slope na yan, okay, your slope, which is your rise over your run, that's your beta. Diba? This is one. And then this one, okay, this is your alpha. This is your intercept. This is your Jensen. Okay. So the higher the Jensen is, it means the better the performance of your portfolio is. So i-clear natin to. Close ko to. All right. So Jensen alpha natin. Let's use this formula. CAPM. Okay, CAPM na naman. And then Jensen alpha. Again, comparing the portfolio returns and the benchmark returns. And then we identify the risk-free rate of return. Daily dapat siya kasi daily yung mga returns. So let's compute this. Our Jensen alpha is, okay, may mga mali na naman ako. Benchmark returns. Okay? Kinopla ko kasi sa taas dito. Okay? Uy, wala na naman.
Missing ng S, sir.
Ay. Sorry, guys. Okay. So, negative 0.05. Okay, what does that mean? Okay, so I'll leave you guys to, we'll look at the implications of this next meeting na lang, no? What's important now is for us to be able to have calculated the beta, yung regular, then yung bullish, then yung bearish, and then the Jensen's alpha, and then also the Sharpe ratio. Okay? So the Sharpe ratio tells us the excess returns being earned for every unit excess of volatility. Okay, so ganun din yung medyo iba yung formula nito, no? So the Sharpe ratio is, okay, let me check kung ano pa rin to, kung, yeah. Okay, not annualized. Okay, so from the performance analytics pa rin, return per unit of risk represented by variability. Okay, so let's just compute this. Okay, given tayo ng risk-free rate daily, tapos kailangan pa i-mention yung yung level of confidence natin. Ito. Okay, if you take a look at this one, ito yung function niya, no? Ng Sharpe ratio. So we're just following this. Ginagaya lang natin default. Okay. So you have here Sharpe ratio. So practically zero yung niya, no? Yung daily return. Okay. And then you have portfolio returns of negative 0.04. So what does this mean? So ano ibig sabihin nito? No? So we will next meeting continue discussing this. Yung Jensen's alpha. We'll just look at the implication ng Jensen, ng Sharp, at saka dito, okay, may mali ako dito eh. Okay, let me see. Table dot, ito, annualized, oops. Okay, this is also from Performance Analytics. Run. All right. So this, actually, this gives us a summary of the annualized return, annualized standard deviation, and the Sharp ratio. Okay, so ito yung ano niya, ito yung syntax. Okay, R is a vector and XPS asset returns to, no? Which is our portfolio returns. Then you have scale, kung daily scale is equal to 252. Okay. RF natin is risk-free rate. Okay, so ginawa natin yung risk-free rate natin is 250. Sana siya? 0.035 over 252. Tama naman to. Okay. Yung scale geometric is equal to true. Okay. Oh, wala na. Tama naman yung ano, tama naman class yung ano eh. Yung pagsunod natin ng ano, ng ay, wait. May doble ako dito. Bakit ako may doble dito? Ayun. So, dapat ito yun. Okay. Ayun. Hindi ko napansin kanina, no? Okay. So, andito yung ano, para i-print natin. So, portfolio returns, it will now create a table which will convert yung mga daily returns natin into annualized returns. Okay, let's run this. Right. Ayan na, no? So our annualized return of our portfolio is 1.16%. The annualized standard deviation is 15.28%. And the annualized Sharp ratio, given the risk-free rate at 3.5, is negative 0.1519. Okay, 15.19%. All right. Okay, so this ends our discussion. Now, ang susunod dapat class is another file. Pero I think medyo ano na tayo, kakapusin na sa oras. Is it okay, class, just to start with this next meeting?
Yes, sir.
Hello, okay lang ba? Sa next meeting na lang natin simulan to para sabay-sabay tayong ano. No? I'm going to share this with you. I-post ko to sa Canvas natin so that before we start the next meeting, you have already a copy. So, ang gagawin natin dito, this is also another portfolio optimization. Pero, i-ano natin to, we will really, yung full process no, ng portfolio optimization. Kasi dito hindi natin kinompute si standard deviation, yung double summation natin. So, next meeting will be a full meeting kasi, so, most probably, we'll start at 6:30. I hope you're available at 6:30 already. So, tama-tama wala akong travel noon na aalis ako ng 5 or 5:30 dun sa destination ko. So, I'll just be here. So, okay ako ng 6:30. Okay, we'll start with 6:30 next meeting. Okay. And then, ito gagamitin natin. We'll use another index. Okay, and then download 40 stock prices. Okay, for this one. All right. Okay, sige, let me stop recording.